I want to talk to you about Warren Buffett's worst mistakes and how to avoid them. Now, most Warren Buffett videos you watch are clips of the great man from Berkshire Hathaway, from his meetings, from his many recorded interviews, and from his lectures. And yes, I love listening to the Oracle of Omaha all day, and I often learn something from what he has to say. He's a great person to take lessons from directly. However, the big problem with just listening to his videos is although you get lessons, you don't always get the answers. So I want to take it a step further, and I'm going to discuss with you a series of Warren Buffett's worst mistakes and how to avoid them. So in this video, we're going to cover cigar butts and Berkshire Hathaway, paying with stock, not cash, opportunity cost, commodity businesses, foreign competition, derivatives, and buying Berkshire Hathaway, but not the reason you think. And if you're going to enjoy this video and you really want to get more of them, please don't forget to subscribe to my channel while you're here, and you'll hear about new content when it comes up, which is fairly frequently, at least weekly. So let's start with cigar butts and Berkshire Hathaway, which sounds like a bit of a mismatch, but I'll show you what I mean. Cigar butt investing is something that Buffett explains that he learned from Benjamin Graham. Essentially, the metaphor is you walk along a street, you look for a used soggy cigar butt, you pick it up and you get a puff. It's pretty horrible, it tastes disgusting, but it's free. When you're investing, what you're looking for is small, unimportant, mediocre, out of favor businesses which are undervalued by the market. Now, the industry and the business is not important. It's just looking for cheap, mediocre stocks, often below book value, often below the cash held by the business, what Benjamin Graham called buying 50 cents for $1. Now, Berkshire Hathaway was just one of these cigar butts. Warren Buffett started buying it in 1964, and by the middle of 1965, he'd built up quite a position. The then president, Seabury Stanton, approached Buffett to buy his stake at a profit, to which Buffett agreed, and he thought he'd agreed a share price of $11.50. Well, when the offer arrived, the price was $11.37.5 cents, 12.5 cents lower. Stanton was trying to chip him for 12.5 cents. Now, Buffett's a very straight guy to deal with, and he's got some very well-established Midwestern values, and basically a deal's a deal. He felt betrayed. I think he probably felt angry. But his reaction was not to sell for that lower price, but he pressed ahead and bought more shares and took control of the company. And as it turned out, this was a very good thing for Berkshire Hathaway shareholders. Buffett's original strategy had been to wait for a short-term upturn in the company's fortunes and then sell for profit, which effectively what Stanton had been offering him. Berkshire at that point was a textile business, which was not only facing increasing foreign competition, which had much lower labour costs, something like 12.5 cents compared to $1 for each dollar they were paying in the United States. But also it was facing a lot of competition from the southern United States textiles companies, where the cost of electricity, a major variable factor in the textile business, was much cheaper. Buffett basically bought the business and then stuck with it and finally closed it in 1985 after many attempts to make it work. He learned a number of lessons from this. First of all, good jockeys cannot win on bad horses. He was always very complimentary about the Berkshire Hathaway textiles management and the efforts they had made to get the business profitable, to look after the workforce, to produce interesting products, but basically the business was in terminal decline. He also learned that time is the enemy of mediocre business, because basically the longer it goes on, things just get worse and worse and worse, and it eventually fails. But it's the friend of great businesses, because growth and earnings as they build up compound to make it even more valuable. He learned also that cigar butts were mostly small companies, and therefore as Berkshire Hathaway grew, he couldn't scale his business with this investment strategy, and that was something Charlie Munger taught him. He also learned that trading in and trading out of mediocre businesses was a poor strategy. Better to invest in great businesses and hold them for the long term. It involves lower dealing costs, compounding earnings, and no capital gains tax. So what can you learn from Buffett's mistake? Well, firstly, don't buy stocks just because they look cheap. You're not buying a lottery ticket, but a share in the business. Make sure that you do your homework on the business, and when you've ascertained that it's a great business, then work out for yourself what you think it's worth, its intrinsic value. Then, and only then, look at the share price and make your investment decision. Beware too of transaction costs and taxes, which will substantially erode your returns. As of 2020, Berkshire Hathaway, I looked at this the other day, Berkshire Hathaway has $73 billion of deferred taxes on its balance sheet. These are basically capital gains taxes it would have to pay if it sold a lot of its positions. But for the time being, it's not selling. So that capital remains in the company and remains working for Berkshire Hathaway and its shareholders. The power of compounding. The next lesson is paying with stock and not cash. In 1993, Berkshire Hathaway paid $433 million for Dexter Shoe. This was a manufacturing business with a great track record of making shoes. But Buffett completely misjudged its competitive strengths and the threat of foreign competition. You would have thought that after buying Berkshire Textiles business, he would have learned this lesson. I quote now from Warren Buffett. "These errors came about because I misjudged either the competitive strength of the business I was purchasing or the future economics of the industry in which it operated." I think in the case of Dexter Shoe, he misjudged both. He goes on, "I try to look out 10 or 20 years when making an acquisition, something good to do, but sometimes my eyesight has been poor." Warren Buffett. Soon after buying the company, its value went to zero, a write-off of $433 million. And he says, "GAAP accounting, however, does not come close to recording the magnitude of my error," Warren Buffett, because that is not the mistake. The mistake wasn't buying Buffett's shoe, although that in itself was a mistake. But the mistake I want to highlight to you is that he paid the stockholders of Dexter Shoe in Berkshire stock rather than cash. And trading great shares for a poor business destroys shareholder value. That's the lesson. By using, quote, "by using Berkshire stock, I compounded this error hugely. That move made the cost to Berkshire shareholders not $400 million, but rather $3.5 billion. In essence, I gave away 1.6% of a wonderful business, one now valued at $220 billion, actually now valued at closer to $600 billion, to buy a worthless business." Warren Buffett. The lesson you should learn from this is summarized by Buffett himself. The intrinsic value of the shares you give in an acquisition must not be greater than the intrinsic value of the business you receive. In essence, don't pay more for something than it's worth. And that applies to making investments in the stock market as much as it does to making acquisitions. The next mistake I want to highlight is that of opportunity cost. Now, this is a relatively unknown point. I've been studying Buffett for many years, but I've only heard him tell this story once. When he was 20, he invested with a friend in a filling station, what we call in the UK a petrol station. Now, at that point, he had $10,000 and he invested $2,000 and lost the lot. At that point, that was 20% of his net worth. Now, he's now worth, in 2021, over $100 billion. So the proportional cost to him of that was $20 billion. And the point is that the cost was in opportunity cost. He then didn't have that $2,000, which he could have invested alongside the other $8,000, which he then went on to build his empire with. So when you're looking at an investment opportunity, don't think about the opportunity. Think about the opportunity cost, because you're looking not for the next opportunity, you're looking for the best opportunity to apply your money to. So if you get that, basically any investment represents not just the investment itself, but it represents the opportunity not to invest in something else because you've made that decision. And that arbitrage, the difference between the two, may have an opportunity cost to you. So you have to understand and learn the principle of opportunity cost. It's normally taught in economics, but it's seldom taught in business school. The next lesson is that of the commodity business. Now, I'm going to discuss Berkshire Hathaway's investment in US Air. And Buffett has described this as a dumb decision and all mine. He also describes it in tennis terms as an unforced error. Although when he bought the stock, initially airlines were regulated and prices were fixed. When deregulation came very shortly after he made his purchase, low-cost carriers came into the market and gradually forced the older airlines to cut their prices to match the low-cost carriers. Buffett said, "I simply failed to focus on the problems that would inevitably beset a carrier whose costs were both high and extremely difficult to lower." Warren Buffett. Airlines are a commodity business. They sell a ticket between A and B. Now, while it's expensive to enter the market, once you're in the market and it's very competitive, competitors will focus on minimally earning their operating costs rather than factoring in their capital costs too. You've seen this for decades in the airline industry. And of course, this leads to a race to the bottom with the businesses with the lowest costs winning. Quote, "In an unregulated commodity business, a company must lower its costs to competitive levels or face extinction. This principle should have been obvious to your chairman, but I missed it." Warren Buffett. The lesson here is that you should only consider investing in a commodity business if it is both the low-cost buyer and the low-cost seller. That way it still has reasonable margins, but will make more because of greater volume. Now, an excellent example of this, and to share a Buffett success with you, is the Nebraska Furniture Mart, founded and run for many years by Mrs. Blumpkin until she was 102, and then sadly, when she stopped running it the following year, she passed away. Warren Buffett. One question I always ask myself in appraising a business is how I would like, assuming I had ample capital and skilled personnel, to compete with it. I'd rather wrestle grizzlies than compete with Mrs. B. Buffett goes on to summarize the business economics. And yet, furniture retailing has no unique selling points in its own right. It should be a really mediocre business. Warren Buffett. They buy brilliantly, they operate at expense ratios competitors don't even dream about, and they then pass on to their customers much of the savings. It's the ideal business, one built upon exceptional value to the customer that in turn translates into exceptional economics for its owners. Let's look now at foreign competition. I want to touch on foreign competition to highlight a lesson we have not addressed, but which is pivotal to Berkshire Hathaway. In both the textiles business and in Dexter Shoe, Buffett invested poorly in two companies which were ultimately destroyed, at least in part, by foreign competition. For years, jobs have been exported from the US overseas to lower cost producers, most dramatically in the car and steel industries. The lesson from this is the importance of sustainable competitive advantage. If you cannot compete on price because of higher labour costs, make sure that your product or service is so special that even if your competitor produces a cheap version, your customers won't buy it. Impossible, I hear you say? Think about Coca-Cola in beverages, Apple in technology, American Express in financial services, See's Candy, which is a candy retailing business in California, owned by Berkshire Hathaway, in retail. I quote again, "The second test, more subjective, is whether their moats," and that's the key word for Warren Buffett, "a metaphor for the superiorities they possess that make life difficult for their competitors, have widened during the year." This is from one of his shareholder letters. So always be looking objectively at a business and ask yourself, what is the sustainable competitive advantage? How can competitors replicate it and how much would it cost? Let's think of Amazon. Amazon's the lowest cost buyer and seller. Its distribution is practically free, its technology is complex and effective, and it makes money from a range of other businesses built on it, as well as such as web services and video streaming. So how would you start from scratch to compete with Amazon, and how much would it cost you, if you could do it at all? Let's turn our attention now to derivatives. This is not a mistake which cost Berkshire Hathaway billions, but it could have. It was maybe only 100 million or so. But it's a lesson which has certainly been learned by both Warren Buffett and Charlie Munger. This is what they have to say on derivatives. Charlie and I are of one mind in how we feel about derivatives and the trading activities that go with them. We view them as time bombs, both for the parties that deal in them and the economic system. And Warren Buffett said this in 2002. When Berkshire Hathaway acquired General Reinsurance, it failed to close down or avoid buying General Re's securities, its derivatives business. It actually tried to sell it after it had bought it and couldn't find any buyers. This is what Warren Buffett had to say. Reported profits struck us as illusory, and we felt that the business carried sizable risks that could not be effectively measured or limited. This business represented very limited upside and virtually unlimited and unknowable downside. It is significant, in my view, that Buffett took this view in 2002, 6 years before derivatives nearly brought down the entire financial system. Quote, "But closing down a derivatives business is easier said than done. It will be a great many years before we are totally out of this operation, although we reduce our exposure daily." The lesson from this is don't invest, and I put that in inverted commas because really what we're talking about is speculation, in anything you don't understand, you can't quantify, and which leaves you with unlimited downside risk. I'll leave the last word on this one to Mr. Buffett. As they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy. Let's take a look now at buying Berkshire Hathaway, but not for the reason that you think. I've kept one of the best until last, but this one is seldom commented on. On May 10th, 1965, Warren Buffett took control of Berkshire Hathaway, but he didn't wind down his partnership, which was Buffett Partners Limited, BPL, until 1969. However, in 1967, he had Berkshire pay $8.6 million to acquire National Indemnity Company. The quote from Warren Buffett. "So why did I purchase NICO, National Indemnity Company, for Berkshire rather than for BPL? I've had 48 years to think about the question, and I've yet to come up with a good answer. I simply made a colossal mistake." By structuring the deal this way, Buffett committed to making Berkshire Hathaway his investment vehicle rather than his Buffett Partners Limited, BPL. In fact, he basically closed down BPL in 1969 and distributed the Berkshire shares in pro rata to the BPL holders who invested in them. Now, he says, if BPL had been the purchaser, my partners and I would have owned 100% of a fine business destined to form the base for building the company Berkshire has become. This saddled him with another 20 years of unproductive capital in the textile business, opportunity cost. The insurance company, which became the foundation of the financial empire, was only 61% owned. Quote, "Our subsequent acquisitions would have been owned in their entirety by my partners and me rather than being 39% owned by the legacy shareholders of Berkshire, to whom we had no obligation." As he put it, this colossal mistake eventually diverted 100 billion or so from BPL partners to a collection of strangers. I think at the time he said it, you can factor that up probably by 2 or 3. The lesson from this is that even Warren Buffett is human. And I find that he's worth studying as much for his mistakes, about which he is always open, as for his successes. And that's one reason I've made this video. I have one final bonus mistake to share with you. omissions. So this is the one final mistake I want to share, and I quote directly from Buffett. Some of my worst mistakes were not publicly visible. These were stock and business purchases whose virtues I understood and yet didn't make. It's no sin to miss a great opportunity outside one's area of competence, but I have passed on a couple of really big purchases that were served up to me on a platter and that I was fully capable of understanding. For Berkshire shareholders, myself included, the cost of this thumb-sucking has been huge. The example that he gives often is Fannie Mae, where he had the opportunity at one point to buy a major stake in the operation for between 350 to 400 million. He started to buy, the stock rose, and he stopped. Shortly after that, not wishing to hold small positions, he sold the 7 million shares he did own. In 1991, he estimated that that was a 1.4 billion mistake. Buffett's lesson to you is that big opportunities in life must be seized. To take a great opportunity and execute on a small scale is worse than not doing it at all. Quote, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches representing all the investments you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. He says, under those rules, you'd really think carefully about what you did and you'd be forced to load up on what you'd really thought about. You'd do so much better. The final lesson that I want to leave you with applies to both investing and to life. And it is, just because you can, don't dabble. If you're going to do something, think very seriously, think very hard about it, do your homework, make an informed decision. Don't just flit in and out of things because you can. And of course, that is so easy to do with stock market investing today. So I hope you've enjoyed this summary of some of Warren Buffett's worst mistakes and my feedback, also guided by Mr. Buffett, on how you can avoid them. If you've enjoyed the video, wherever you're watching, please subscribe or do whatever else is applicable. If you have a favorite lesson from Warren Buffett, why not share it in the comments or message me with it, whatever you can. So this has been Warren Buffett's worst mistakes and how to avoid them. I hope you've enjoyed the video and I look forward to seeing you very soon again in another one of my investing and financial videos.